again, picked up from 100 of startups we've seen over the last few months. In a couple of weeks, I can't guarantee any timing, but in a few days, we're going to pick what we consider to be the finalist. So a subset of startups that we'll invite to our accelerator program. So get ready to come and fly to San Francisco the first week of January. That would be January through March. Okay, so that would be the next step. So you will hear from us online. Now, our friend Eva Farnetti is going to manage the panel about Incubator. I'll leave you the floor. Oh, am I supposed to be here too? I think so.
I think this is the part where founders and entrepreneurs are going to have the chance to grill all of the people on stage. Because normally you're the one in the hot seat. You're the one that get the difficult questions. So I want you to take a deep breath, get out your knives, start to sharpen them for the next 10, 15 minutes while we talk a little bit about the sector, and then get your questions ready, because this is the chance to really grill these guys much more, and me. I mean, I'm part of the industry as well. So we're going to have about an hour before lunch to talk about the seed part of the industry. I'll provide a couple of slides of context for all of us, and specifically to address the fact that why seed investing for internet companies makes a lot of sense. And then we'll open up to the panel. I'll ask everybody to introduce themselves and what they do for a couple of minutes so that you know exactly the difference between each and every one. And then I'll fire up a couple of questions, and then it's going to be your time. All right. So the basic rationale for seed investing in internet companies and internet startups has to do with a concept, and it's a concept of risk. Risk has a cost associated to it. And in early stage investments, there are two types of cost that we as investor or you guys as entrepreneurs have to consider very carefully. One is the cost of knowing that you're right. So if you go back for the last 10, 15 years, right, and you look at the type of industries that have been invested by venture capitalists and investors, what you realize that to make a successful company, it takes a certain amount of money. So these numbers are directionally, right, correct. So if you take the software industry and you take a company that you generated with your idea, it would take probably 6 to 7 years and about $50 million to prove that your idea was right. In telecom, because it's hardware, it takes more. Semiconductor, it's even more, right? Solar technology, that number could be 200 or 2 billion because it's really, really high number. And for generic internet, it's still 40 million. If you look at some of the successful companies that you think of, they were not cheap. Everybody raised a lot of money at some point in time. But here comes the second part. And it is the cost of knowing that you were wrong. So 10 years ago, if you had to start your own software company, you would have to buy hardware, get DBAs, get technician, get connectivity, lots of time, lots of money. Even before you write the first line of code, you would have to put together between 4, 5, 6 million just to buy the hardware and the rest of the technology. And then you would need about 2 years to do the testing and put it together. So before you know that the product doesn't work, or even worse, before you know that the customer don't care, you're down 7 to 10 million. The number for telecommunication or for the other industry is very, very high, right? Or was very high. And even for generic internet, you would still have to buy the hardware, get all of the software stack, get the connectivity, get the maintenance people in, and all the rest. Now, this is what has changed in the last 10 years. Because today, the cost of knowing that your brilliant idea did not work has changed in some of these industries, but not in all of them. So specifically for software companies and for internet companies, that initial cost to know that your idea really wasn't worth pursuing, it's a fraction of what it was 10 years ago. And specifically in the internet world, for a number of reasons, this cost is becoming so small that even with a little amount of money, probably as little as $1 million, you will find out in probably a year and a half maximum, if that idea was wrong, which means you can do something else with your life and with your money. And the techniques and technologies that have made this possible change are open source software, hosted solutions. You have Google to do your distribution and advertisements, right? And so on and so forth, open APIs. So I want to do one more slide on that 1 million at the bottom, because all the people on stage have a responsibility towards a fraction or all of that first million. So we've all seen the stack of the industry. So this is how the money industry looks like. For those of you who have raised money, I'm sure you have gone through a lot of the permutation. And when you go and speak to some of the investors, you're talking about what risk are they going to fund for you. Now, if you're a concept, so you have a great idea for a phenomenal new restaurant chain, right? You have to let them buy into the idea. That's a concept risk. That is normally funded better by friends and families and maybe crowdsourcing if that's going to be a reality at some point. After you have defined that the idea makes sense, right, and you can explain it, you have a design risk. How is the product, how is the solution going to stack together? All of the bits and pieces. And that's where the question and answer that you see sometimes on stage is very symptomatic of what happens when you have an investor like the one sitting on stage right now, right? Is that Q&A, that testing of the idea. Incubators and accelerators do a fantastic job at that. Some of that can even push to give you great advice on products. I think there are some of the people in the panel that are probably the smartest guy I know when it comes to defining the product and the benefits, especially on internet companies. Eventually, you will need a little bit more money because the product works. You can demo it. It stacks together. You have your first 1,000 customers, and then you have to get the market validation. Are there others behind those first 1,000? Can you get to 100,000? Can you get to 1 million users? Eventually, you arrive to the larger VC funds that can write you checks of 3 to 5 million. Eventually, you will have to explain how you get international growth and presence. You create a fantastic big brand. You're worth a gazillion, and you go public, right? So that's the stack. But today, on stage, we have great representatives of the early stage part of the market. And if I'm, do I have all of you? Yes. Oh, Carlos is gone. Carlos has made his advertisement. He collected his check, sponsored 2 of his companies, and now he's gone. I think he's probably going to come back and promise me to grill him even harder for this. So we have Cesar Telly from Connect Ventures. We have John from Springboard. We have Carlos, absent. I think the name is Luigi, it's not Carlos, right? Luigi, and we have Marco, our host, and myself. So I'll pass it over to you guys, and maybe start from Luigi. You want to say a couple of words about your business, and then we continue.
Hi, thank you very much. Okay, I represent an accelerator and incubator. The name is L-Venture. L-Venture operate in Rome. We have today 400 square meters, 20 startups. In the near future, we are going to move in a new space with 120 desks, and probably it means about 40 startups. We have an holding company, and we invest in startup. We invest micro seed. We give it 30K. We have a program, a 6 months program, and after that we are going to put other money when we start the fundraising with other investors. We invested in 12 startups till today, and we are going to list L-Venture before the end of this year. Thank you.
So I'm with Connect Ventures, which is a London-based seed and A-round fund that started in January this year. So far we made 6 investments, including 1 in a seed chem company and 1 in an N-Labs company. So we are at the part of the market that's after the incubators and accelerators that are on the panel. Focus on internet and mobile companies, both consumer and B2B. So we also do I guess what Ivan would have done as a software company, as well as what you would do an internet and consumer.
My name's John Bradford. I run Springboard both in London and Cambridge. We're a traditional Techstars Y Combinator 13-week bootcamp, current in situ in London at the minute. We are moving toward trying to break a few rules and trying to flex the accelerator model. At the minute we're just doing mobile only. It was quite encouraging that 3 of the 5 teams had some input into the mobile industry, but we personally believe that the model is not fixed. It's all about how it changes and how it evolves. The market itself is moving really rapidly, so we have to do exactly the same thing.
Thanks, John. How many of you have heard of Seed Camp before today? Okay, a few of you. Great. I met some of you last night. How many of you have applied to Seed Camp by any chance, or Springboard or Seed Camp? Okay, cool. Excellent. So Seed Camp is a micro seed investment program with a mentoring program attached to it. We provide advice, capital, network, and validation. And we have a rolling admissions process. Every month we go to a new city to meet new companies and make new investments. We've been all over the world, as far as Singapore, South Africa, and obviously we go to our key hubs, which are London, Germany. We have a third of our investments from Eastern Europe, and we have 73 companies that we've invested in total. The real value of being in Seed Camp as a company is you get a strong network of alums, of people that are like you, that have done a lot of the things that you have done. And our network, the mentoring network that we have, also helps companies build and grow. And in many ways, the Springboard and Seed Camp have a strong network of mentors that can help in that. So, just as a quick addition to what John said, the key value of an accelerator is providing a strong foundation for the company to grow.
Well, if you don't know what we do by now, we might have a problem. So, no, actually, we do have a new piece to our story. So, we've been doing kind of an accelerator program for 5 years now, but the piece that we added is the financial piece to it. So, I just launched a fund, and the dynamic of the accelerator is pretty similar to what we've been doing, although the idea is to going through this filter and then invite the startups in Silicon Valley where we run an accelerator for 3 months. So we kind of decided to structure what we've been doing in a way that is a little more standard to some extent, and to be fully aligned with the success of the startups, which is entering in their investment, in their equity. So we do, we have terms very similar to Seed Camp or to 500 startups, and our sweet spot is to get and find the best IP at an international level and to land them in Silicon Valley. So to expose them, to package them as a Silicon Valley company, to be eventually accelerated there.
Okay, so taking exact lead from where you're leaving us, Marco. And I mean, over the last day, the one thing that I've heard most of you and most of us talk about in this room is Italy versus the rest of the world, Italy versus Silicon Valley, right? And entrepreneurs are thinking, should I get my first employee here or should I go there? Should I have my office here or should I go there? Should I incorporate in Italy or should I incorporate somewhere else? Now, because you're on stage, I'm going to ask you a delicate question. And the question is, should an entrepreneur who's raising his first or her first dollar, should they raise it from a local incubator, accelerator, or fund, or should they bypass that and go for an international one?
If you want, I can answer that, because I get that question all the time from companies that we invest in. I think you have to start thinking global. You have to start from a global ambition. So if you're looking for a local business and your play is a local, we saw a company, actually, you and Ivan, the supermarket one, I forget what it was called, but anyway, it was a very local play in Italy. And in that case, you know what? Stay in Italy, get Italian investors, get the best Italian mentors you can get to help you enter into the market that you're going after. That's without a doubt the best thing to do. But if you're going after a global market, there is no need for you to be thinking just from the perspective of quarantining yourself in Italy. We invest in, for example, Eastern Europe companies. What ends up happening is that these Eastern European companies have their development team in Eastern Europe. They have a headquarter, maybe a business headquarter in London, and the company is incorporated in London or in the United States. And then there's an office, maybe it's a sales office, or maybe it's the headquarters that are in San Francisco. And that's kind of the evolution of the new company. It's a global company. Where that's incorporated is irrelevant in terms of any kind of nationalistic ties. It's about what is the most efficient jurisdictional structure, and that's either a UK limited or a US incorporated company. And then you place the people where they want to be, whether it's your development team that's in Italy or whether it's your headquarters in Italy. That's quite flexible these days.
Yeah, I have to echo what Carlos said. So startups are hard. They're really fucking hard. So you want to give yourself the best chance possible. And I think whether it's an internationally global-minded accelerator like the ones up here, or an internationally minded seed fund like Connect Ventures is, I think that just helps you get that much farther ahead and makes everything that comes afterwards, like the next rounds of capital, thinking about business models, hiring, everything you have to do just a little bit easier, and you want to give yourself the strongest advantage you have.
Well, hello? Yeah. In my opinion, I think it's really very important to start at global level, but it's also important to bootstrap, to start very, very fast. So what I mean, if you spend months to find an international investor, why don't you come to us? In 3 months we give you money, in 6 months you are in Berlin or you are in San Francisco? This is my question.
Anybody who want to challenge this? Either way. No?
No, I mean, the one piece that I would add, though, and again, we've been doing this for quite some time. We've been doing it, especially for Italy, although we want to move a little bit more international, but we see the situation is very similar to other countries. So, the idea is actually using Italy pretty much as Eastern Europe and other countries where, in fact, hiring people and good developers is an asset. Now, the challenge there, though, and I'm going to be some controversial here, is to, if you start getting money locally, some of the time, those money fucked up your cap table, and so you get to a point where you cannot move to the next level because you're not standard anymore. So if you get to local financing, sometimes it's easier to get, but you need to be very careful that the terms that you accept in there wouldn't put you in a position where it's impossible then to do a round A somewhere else. So the key question here is to move the market to a level where the terms are more standards, are more international, and I think, on the positive side, I think we're moving that way. So most of the people, CCAM does this, are starting, sharing the terms, and I think that's eventually the key question.
So yeah, I'll add to that, just because he just mentioned it. If you go to, how many of you have seen a term sheet before? Raise your hand. Okay, not all of you. Yeah, okay. If you go to seedsummit.org, you can see the term sheets that are being used by quite a few of the VCs across Europe, and they're available in English and in other languages. I don't have Italian yet, so if you have any Italian lawyers in the room that are willing to translate it for us, I'd love to. For free. Would love to talk to you afterwards. But I think one point that I wanted to add to your comment earlier is that we're not necessarily discouraging local investors. What we're discouraging are local investors that can only think locally.
We want local investors that think globally and provide a platform for that company to grow. So here we have Lorenzo here in the front. We have Pietro in the front. I know these guys. I know these guys think global from the start. You go and you talk to them. You don't go. There's other people who might be rich individuals who just want to have it as a tax evasion loop or something. You don't go talk to them.
Yeah, I think as an investor that runs a fund that comes after most of these guys, my take on that is really very much in line with what you said, Marco. I really don't care if you're incorporated in Italy or in the US. I'm a European investor, first of all. What I care is that the terms that you have in your corporate structure are very, very similar to the one that I find everywhere else. So the initiative that Carlos mentioned about the generic seed term sheet or the generic Series A term sheet is something where probably 20 VCs have participated and co-authored it? 27.
Yeah, and 8 geographies.
Right. So we've put a lot of work to make sure that no matter where you are in Europe, you can take that term sheet and use it as a start. And if you can have a good lawyer that implements it under the local jurisdiction, but makes it looks like those terms, I think you will have no problem after that getting money from other VCs. Well, let me pass to the second question. I talked about the cost of knowing that you're wrong, right? And sometimes that cost is a very seed round. It could be 100,000 in 6 months. Sometimes, however, as we all know, things don't go exactly like you want them to. And maybe you need another 6 months because you're not really sure. Development took a little longer. To find the right guy took a little longer. We just launched the beta a little later. So one of the questions that I have for you is some seed investors only do one round, 50 to 100K for 1 year. Don't expect anything more. Some others say, well, I'm willing to give you a second chance. I'll put another little bit. I'll give you another 6 months. I would like to know what you think about it and what your companies do.
So I can start on that one. So we've made 6 investments this year, 4 of which were seed. But the average investment was actually £300,000. And the reason for that is because we look for companies to not just have 12 months, but actually the way we view it is we think kind of long term along the plan, you're going to need another round of funding in the future. It takes to raise a good A round 3 to 6 months. You need to have enough time to actually show progress and really develop milestones and hit your milestones in that time. So we look for a funding plan that gives you 15 to 18 months, which, depending on the company and the sector you're in, is enough time for you to really progress to the next level and then start your next round of funding. But one of the things we also always keep in the back of our minds is that it may not work out to plan. In fact, it probably won't. And one of the things that you're going to need is possibly a bridge. So that's always something that we take under consideration and reserve for. Just because we've been doing this for a while and we understand that things don't go to plan, and we're trying to be very, very supportive of companies. I think that's the philosophy we've seen work best in the seed investment round.
I think that the graph that you showed earlier, which talked about design and product market fit, is constantly shifting. So I'm even what is perceived with accelerators, which is meant to be early stage, I see much later stage teams or teams that have progressed much further with much less capital. A very extreme example of that is I have a team that's sitting in London today from South Korea, and they've built a user base of 1 million users in 4 months, which is utterly amazing. And so I'm not sure where that sits within that kind of scale. The one thing that you'll find that I will push and a number of other people will push you prior to even getting your investment is, can you finish a product? Can you just get it out there? Can you show some early engagement? So the seed funding is actually not even to do that product market fit. It's actually to say, you've sort of got something there that's getting some level of engagement. Now, how do we start to learn more about what that engagement really is? So the whole dynamics of this market are shifting and moving. The other big advantage that both myself and other accelerators and SeedCamp have is you can learn a lot of that stuff from putting other smart people in the room beside you without necessarily having to say, I'm going to put it out there for the next 90 days. let's work with people who actually have had experience of actually seeing what these things look like, and are there ways to mitigate the risk, or are there ways to kind of say, don't do that, that's a total waste of time, I did that for 90 days and I just wasted a whole bunch of effort. So it's partly to do with building product faster, and it's about speaking to as many smart people as you can.
So Ivan, I know you like to get to people to open up the kimono as answering questions. So I know you want a clear answer to the why don't follow on money. Let's look at the accelerator, and I'm speaking for any accelerator where you invest in a large group of companies. One of the issues you have is signaling. If you choose some companies versus others to provide follow on for, you run into certain issues. But before I go down that path, let me first answer another question. A seed investor at the accelerator stage is looking at very, very, very early stuff. We're not talking about the stuff that Connect Ventures is seeing or any of the sort of seed stage investors are seeing. We're seeing stuff where there's one guy or two guys with an idea, some of which the product isn't finished. My job is to help them optimize their money and their time. And sometimes that means, guys, it didn't work out. You learned a whole bunch. Come back with a new idea. And we've seen that happen a few times, and we've made investments in the second or third iteration of the product, which then got third-party validation for follow-on capital. So at the stage an accelerator plays, it isn't necessarily our role and function to provide bridge capital for something that the market clearly does not want. What we're doing is we're training entrepreneurs to be the best entrepreneurs they can be so they can come back with something that works better. And it usually happens the second time around. And then, going back to your original question, then we make sure that they meet all the right people so that they can get external validation of financing so that a program like ours can do follow-on investment, but without providing a negative signaling effect of I like this child more than I like this child, which I think it would be a very awkward situation to be.
Okay. From my point of view, we are investors. So if we think that we can make money with that startup, we are ready to make a bridge. This is our thinking. That's all.
Actually, our position is pretty different, and damn it, you say most of the things I wanted to say, man. But this is the very core, I think, of a difference between an early stage investor and an accelerator program. The core of the accelerator program is not a financial part, at least not in our case. If you put 50, 60K, this is just to cover the expenses for having a team of two, being fully focused, not having to work at night doing some other stuff. But the big piece that you are working on is really the added value in the 3 months where you have 60 mentors that are working on a project themselves. So if that thing doesn't work the first time around, it's a pass on our side. So clearly you need to have some follow-on investments, but that's not the sweet spot.
I'll come back to that. One of the interesting things is very specifically what we do, I think probably less so with Seedcamp because you're slightly further down the food chain, is we build our programs for failure. We assume that when we have 10 teams that a proportion of them will fail. But the reason why we do that is because we actually want to try and do stuff right on the edge. I think one of the interesting presentations was the idea of renting a flat with somebody else's stuff in it. That's completely bonkers. But actually, the weird stuff is, if you go back 3 years ago and talk about Airbnb, people would have gone, that's completely nuts. Yeah, interesting stuff. And Paul Graham talked about this recently, which is the black swans, which is sometimes you've got to look at the crazy people in the room that are doing really crazy things. And when you put a portfolio of 10 teams together within the program that I run, I assume that there'll be 2 or 3 nutters in that process. And on the balance of probability, they're probably going to fail. But on the risk that they might actually have there might be something in there, we put them in. But we build portfolio from day zero. I mean, the question I would ask you is, why would any seed investor follow if somebody else isn't going to put money in. It's a slightly different question, and it's more often that it's not that nothing's happening. There's something happening, and it's more a bridge rather than a follow.
Yeah, I think if you're running a broad accelerator, right? If on top of your door there is no venture capital, but it's acceleration, I think you guys expressed probably what seems to be the smartest answer that the consensus of all the people in the industry are giving, which is a bridge. It's always possible, but it doesn't, manifest itself into setting a new valuation or validation. Whereas if another investor comes in and you guys want to continue to maintain your stake, I think that's the validation. I think I would second exactly that point of view. All right. We have another 20 minutes. I have 15 other questions, but I'm thinking, you know what? I think you've been sharpening your knives, getting your mind sharp, and I think you have even far more, probing questions that I can ask. So I'll lie myself on the other chair and share the fire, and I actually would like to pass over to who wants to ask the very first question. Come on.
Seriously? No one?
Come on.
Can I answer a different question that you haven't asked yet?
Okay.
So I actually would challenge the numbers that you had at the start, which talked about software and internet and semiconductors. So this is not for public disclosure, but later in this week, he said, in front of a room of full of people, we're just about to go and do open hardware in exactly the same model, because we believe that in the way that web technologies have fallen away in terms of cost base over the last 10 years, that the open hardware movement, Arduino kind of maker community, are going through comparable falling costs, which is the ability to prototype stuff is really early, it's getting really cheap, the ability to build low scale volume of stuff and put it in the marketplace is much cheaper, your ability to scale with outsourcing from manufacturing point of view, you don't have to have your own factory anymore, are kind of following the same dynamics. So I think one can look at what's happening on the panel today and talk about it as internet, but the thing that I look at and challenge is where else can you do similar things like this? And it's not just as an accelerator, but can you do similar things at early stages to do product market fit and validation in other industries with relatively small costs of money?
I think it's an excellent question. I think that was my question number 15, actually. And I think it works like this. Every time, and I think all of us do judging panel almost on a weekly basis, right? And in the audience, there are like lots of smart guys just like you. And company after company, after a few months, we start to detect a trend. And this one really doesn't take much. A lot of the companies that come up here in all of these startup events are actually very similar. There is a website, there is a mobile app, there is a website and a mobile app, right? And it's derivation of the same thing over and over. If you look at it from my point of view, which is I can invest in whatever I want, they look very similar. And the acid test for that is what happened 3 minutes ago when I think the guy that came up and talked about the enterprise nodes, access nodes, with a piece of software that runs on top of it, all of a sudden got a few of us a little interested. First of all, because it's a brilliant and smart idea. Second, because he presented really well. And third, because we don't see that very often. So I know, John, you've been working really hard to look at to something that for the last 5 years it's been considered radioactive, which is hardware, right? Because we lost a lot of money. And here's the problem. When you have a microchip and you send it to Korea to manufacture and you get a test back, right? It comes back with a bunch of bugs. If the bugs are serious bugs, it's 6 months and probably another $5 million before you can spin it again and find out if you were wrong. So what are the drivers that can help our industry? What are the tools? What are the fundamentals that can help our industry to believe that we can invest in, let's talk about hardware for a second, and still have the same economics and risk than when we invest in apps and websites?
So So actually, hardware is actually an area that we look at a lot. We don't look at as much things like microchips at all, actually. But what we do look at is an area. I don't know what the name for it is, but it's basically commodity hardware that's linked to a service, whether it's an app or an online service. And one of the best examples is, okay, this isn't from a startup, it's from Nike, but it's the Fuel Band. And I actually think Carlos is wearing one as well. And it's I'm pretty sure there is nothing in here that isn't just pure commodity hardware, right? The real value is in the design, which is typical Nike, very industrial, and in the software platform, which is a mobile app and a website. And that's where the real value is, right? That's where Nike gets you, right? They track how much you're walking, and then they suggest you buy a new pair of shoes. And those those types of companies are actually very interesting for us, because I think consumers have. It's really hard to get people to pay for anything, to get people to pay for software, right? Getting someone to pay $10 a year for software is actually really hard. Getting someone to pay $100 for something like this is really easy. And that's 10 years of your software paid for. So and people have a very strong emotional attachment to physical objects that they buy. So it's an area that we look at a lot. And if you look at the trends on platforms like Kickstarter, that's something that the market is bearing out, that people are willing to pay for devices that they find interesting, that are connected to software platforms and services that join them in a network that does really interesting things with the data that hardware is collecting.
And I think that's the thing that's going to actually make the difference in this market and start to make VC sit up, is the last word, which was data. This is where big data turns into what I call absolutely massive data. When you have devices around you and about you that are collecting metadata about you, where it becomes the old style model was a very simplistic model, which was, I have a device, it sends data, you have a service. Where you start to have, and there's a lot of people looking at this at the minute, your ability to have multiple devices to be talking to each other, and when you can actually start to join up some of that data and actually start creating inferences from that data, that becomes exceptionally interesting. But actually, that's the stuff that VCs have been dealing with for the last 10 years and are starting to understand the value of the data. It just happens to be, there happens to be a bit of a device that sits there in terms of trying to collect that data. And it's also, it's not skewed. So it's not, I've sat and done something on a phone and said, I think I feel better today, or I feel worse. This is kind of very objective data that sits in the background, and the core to this is when the data that's being collected, you don't even realize it is being collected, it becomes really, really valuable because it has that objective nature to it.
Oh, we have a question. Go ahead. Wait for a second. There is a microphone. You can say your name and...
Yeah, sure. Right. I'm Benedetta Borri, and I'm in a development team of a new startup that we are just creating. And I have two questions. One, it's very easy. It's a matter of visibility. So I know that every one of you really for sure has many, many requests from different people with different ideas. So first of all, what do you think is the best way to get on you? So it's the best way to reach you. Do you really read the emails or the the uploaded that we do?
We'll be out here for coffee if you want to talk.
Okay, I will come. I will come for sure. So that's the first question, and the second one, it's something we are really working on. So we have the idea of a global project, okay, but we are in a sense in a situation, in a condition in which we don't have so much money to spend for the moment. So the question is, will you spend money to find someone that evaluates our idea in a valuable way, or do you spend money in creating a software or a beta version and then find someone else who is going to accelerate it? Because actually, our main question is right now, what about if I develop a beta version, a software, and I spend a lot of money, and then once I'm there, nobody's going to buy it?
Just out of curiosity, how many of you have read the Lean methodology from Eric Ries? Okay. Have you read it, by the way? The Lean Methodology by Eric Ries.
Lean Startup.
Okay. I would suggest you start there. And the reason, it's not a flippant answer to your question. I know that there is a process when you have to start building things. But you'd be surprised. I mentor at the Lean Startup Machine, which is like a weekend camp for understanding the Lean methodology. And there's a lot of business-related validation that you can get without building anything. And so depending on what your software is, I don't know what it is, we can talk about it in the coffee. I think the first thing is to validate the commercial proposition, and you can do that over the phone. You can fake it. You can have a website with links that show traction, and you can put some AdSense to see how many people are interested in the proposition and see what the conversion rate is. So there's a lot of things you can do to validate whether there's a market before you start building. And then when you're building on certainty. So that's probably the best way to tackle it. And then you're building on certainty.
I'd say, I mean, I don't know if you saw Marco earlier from Mashape, but they coded for like 10 months on, noodles and coffee without spending any money, and then raised 100,000 in their seed round. So I don't think, I'm a strong proponent that actually money solves almost no problems when it comes to startups. I usually, if a startup comes to me and says, we need more money to grow bigger, it's usually a red flag for me. It's not really about the money you need. If you can build product pretty easily, very cheaply, with just your time. That's the biggest investment you make. And I'd really encourage you to read Lean Startup and a lot of the other discussions around that methodology. There's a couple of other and some variations. And I think that'll help you kind of get the mindset of building. With regards to your first question, I think you're right. We do get a lot of inbound requests. We do read every single email we get. But if you want to, rise, I guess, one level above on the attention scan, probably get someone to refer you. So someone that I know and I trust, and that's not hard to find. If you look at Twitter, LinkedIn, I don't have a public Facebook profile, but if you look at who I know and who I talk to, that's a very easy thing to find. You get someone there to refer you to me, I'll instantly respond, whereas, and I'll just take it a little more seriously because it's gone through already a filter.
I can give you a statistic. In our case, for example, we give 30K, and the startup never spend all this huge amount of money. They never spend, and they arrive in the end of the 6 months with the product. So the product is probably normally is 15, 20. What we suggest is to create a team, very strong technical team, so you don't give money to anybody. You develop inside.
I can outdo that. I had a team that turned up last time on Springboard, and on the first day they walked me into the room and said, we need to tell you something. I said, what's that? And they said, do you know that previous idea we had? And I said, yeah. And they said, it was rubbish. And I said, yeah, I know it's rubbish. And they stopped it on the first afternoon and the first day of the program. Bit scary. But essentially they had to do what you had to do, but even in shorter space of time. But effectively, within about 2 weeks after speaking to a whole bunch of really smart people, they actually ran a smoke test. They just put up a blind website, ran it across Hacker News, and basically said, this is the service that we're going to run. This is the free version. This is the pro, and this is the professional, or whatever it was. Can you indicate which ones you will be paying for when we launch the service? And they immediately got enough feedback just off that blind test to indicate that they were onto something that was interesting. They hadn't built anything. But it also demonstrated that people were willing to pay cold hard cash, not just use the product itself. They're currently sitting in San Francisco at the minute with venture funding. The Palantir one, Trey. Yeah.
Look. Let me just address the one piece of the question I think is actually going to do a favor to all of us. So how to talk to an accelerator. I mean, specifically how to write an email. In fact, we should run modules just about this. Like number one, if you haven't read the Lean Startup, if you don't know what a Lean Startup is, this is a red flag. I'm not saying that it's a mandatory reading, but yes, it is. At this stage. So that's what we end up doing. So, the value of an accelerator program very early stage is the deal flow that you have. So you get all sorts of crazy stuff, which is cool. Actually, I enjoy it a lot. The craziest, the better. But the amount of, limited energy that you have to filter. So the issue that you encounter is to go through a lot of false negatives. So people actually had some value, but you just passed because the way of interacting was awful. So the one thing that we should probably work on, in fact, is to give clear signs and terms how to communicate with us. And if you start writing emails that is more than 20 lines, again, we have a problem. You start reading vertically, and so you miss the point. So there are very clear and easy ways to do this, and it's probably also our fault. And especially with Italians or Latins in general, there are a number of idiosyncrasies that where the communication issue is always something that probably with Anglo-Saxons you don't have to explain, but eventually they become part of the problem. So the to-do on our side is to give models how to communicate in a way that is effective, how to write an email, 10 lines, links outside, and on your side to do your homework in doing this. But the value for us is to read as many potential ideas out there as possible.
Any question?
Another suggestion I can give is when you start a business, try to be connected. I mean, try to stay in a place where you can speak every day with other people, and don't stay at home. Don't stay at your home.
Just as last comment on that point, you can either take a choice. Either VCs or we are lazy bastards, or we've got very limited bandwidth. And you have to figure out how you get to us. And actually, if we're trying to be hard, it's not on our side, it's just because we are genuinely bandwidth constrained. If you can get to us, that's kind of half the battle, yeah? So hustling is something you have to do throughout the life of a journey of a startup. Making life really easy at the start doesn't really help you. If you can hustle and you can get to a VC and you can get coffee with them, you're starting to get in the right direction, because that's a skill set that's required throughout the life cycle of a business. If you can't do that, you're probably not well suited to actually being in a startup.
And one of the things that I take as a red flag is if we get an email in to just info at pitches, I just think you didn't really try very hard to actually get to me, right? Because it's not that hard to find my email address or to contact me by other means in a more personal way. Yes. Yeah, or just guess what my email address is. It's really not hard. It's cether@connectventures.co.uk, by the way. And so if you're not even trying at that level, I have to think, again, startups are really fucking hard. So if you're not trying to get to me, how am I going to invest in you when you're not going to... If that's your mentality, why would I back you? You're not going to try very hard. That's the way you approach life. So it's a flag for me, big one, actually.
But let me give you a little more context, right? So it happens sometimes that we like you a lot, right? You are the hottest thing in the planet, and I want to get a meeting with you. So there are probably 3 or 4, maybe maximum 5 companies every year in Europe that have that pedigree, right? And that is when the game is reversed. I can tell you, we were working on a company in Sweden, and I've been after them for 6 months, constantly hammering them, getting referrals, getting to their board members, who invested before, who's the chairman. Honestly, I invited them to a Manchester United game. Everything. Short of taking them to a strip club, I think I've done everything I could possibly do. Now, look at yourself, right? You're saying, oh, I send you an email, I crafted nicely. Okay, if you are in the food business, send me a product of yours. If you are in the fashion business, send me a t-shirt with your logo printed on. If you browse my CV, and it's all over the place, all of ours are all over the place. If I'm into football, cycling, kickboxing, whatever it is, swimming, right? Take me to an event. I'm not saying that because you have to do it, but I'm thinking the angle that you can have about our personalities. I mean, we all have Twitter streams, right? Look, I'm in London for meeting some of the accelerators. I'm really too early with my product. I really don't have it. But could I get a coffee time with you? Could I have 15 minutes just to show you one thing, and I'll come back in 6 months? A coffee is less threatening than a lunch. A lunch is less threatening than a dinner, right? I don't do dinners. I have a kid at home. Dinners are really expensive for me. If I'm here and I'm traveling, I don't mind because my family is away. But all of the other easy stuff, at breakfast, I'll buy you coffee at 7:30 in the morning. All right, I know you want me, right? So that's how it gets played. And the really smart guys, they do all of this and more. There was another final question.
Bribe Ivan, it works.
Yeah, please go ahead. One more.
Yeah, I think we are now seeing two main trends in your industry that might change your industry. I mean, and I personally think that online college classes of entrepreneurship, for example, Udacity, or and crowdfunding. What I'd like to ask you is, do you see these new tools, let's call them tools, as threatening your industry and or just as supporters? That, I mean, might it change the business? Might it change the industry? I mean, crowdfunding for early stage investors and online classes of entrepreneurship for educators has burned the bridge. Do you think it might change the position, or you have to review your position, or not?
So let me talk to crowdfunding. I think they're fucked. I think good teams always get money. So essentially, the stuff that sits on crowdsourcing platforms is stuff that doesn't get money. Yeah. I also think that from a funding point of view, the expectation of getting a return over 5 to 7 years is just not reflected through crowdsourcing platforms. The idea of actually, I'll invest something and I'll come back in 7 years, I think there's a massive mismatch. The flip side of that is I think Kickstarter is awesome. Yeah. Because there's instant gratification, or very close to instant gratification. I pay something, and at some point over the next 6 to 12 months, I might get something back. Yeah. So crowdsourcing platforms, having said that, the other way round, I think can be used as a way to top up funding, but not necessarily as a primary driver for funding.
Sorry, I was going to answer the other question, which was about the education and online education. So I think one thing that you will never ever replace is screwing up as a way of learning. You cannot replace that with some book or with some online course. You can never. And the lessons you learn from networking, from creating partnerships, doing biz dev, doing your own financials, going out and talking to people, you will never be able to replicate that into some sort of neat course that you download via PDF, install on your Kindle, and read while you're eating chips. It's not ever going to be that way. So no, we don't see it as a replacement. If anything, we see it as a partnership, because a lot of our companies are coders, and they don't necessarily have a background in accounting, for example. So I might enroll them in an accounting program if it'll help them understand that, if that's an area that they want to pursue a little bit further as part of their regular admin. That's maybe how it would be symbiotic.
So I think both of the movements are fantastic and actually quite complementary. So the online education is great because you will ideally get more informed founders and entrepreneurs, and the crowdfunding is a great market test. So I view it as some of our companies are considering doing Kickstarter campaigns or Indiegogo or whatever. Those are probably the two you should stick to. It's a marketplace. Size matters. So it's a great way to validate a lot of things, and especially if you're doing I think with physical objects, those work well. But I don't see them as a threat, only because I think what VCs bring beyond money is actually quite helpful, and it's not something you can replace with a crowdfunding model and with online education. And it's similar to what Carla said about the education online doesn't bring a lot of the benefits. I think it's the same with investment. So you can raise money from all the people that love your product, but they're not going to be able to introduce key hires for you, or to the business partnership you want to make, or help you avoid all of the common mistakes startups do. So I think that part of it is you generally need someone, whether it's an incubator or accelerator or a VC eventually, you need that, and you're not going to get that from a crowdfunding model.
What I mean for...
I'm going to pipe in with one last comment. If you are not on AngelList, how many of you heard of AngelList? Okay, yeah. Basically, that is the new platform. It's not exactly crowdfunding, but you at least get exposure of lots of investors, which could compile together into a round. But everyone go and research AngelList and be on it.
I think, from in my opinion, crowdfunding is really very interesting. I don't think we are really competitor, because crowdfunding, you have to think that. Or in our case, we give smart money. So crowdfunding in the end is money. And from other point of view, I see so many business plans that sometimes I would like to invest in other kind of business that are not in my objective, in my aim. But with crowdfunding, you can do so. It's another business.
Actually, what I mean for trading is that I have a brilliant idea. Let's assume.
Speak in the mic.
Yeah. Let's assume I have a brilliant idea, and instead of presenting it to you and pitching, I go on Kickstarter and I raise 100K, and I will sell you, like in the future, the 10% of equity for 10 times what I would have sold you before. So that's what I mean for trading and and reducing your amount of business.
Yeah, I would do it if I were you.
I prefer to invest in a business that's more likely to make money for me than to go to the casino and put something on like one of the numbers. Yeah. So actually, what you've done is you validated, and whilst we buy in at a slightly different price, and we might not make as much of a return, making a 3 or a 5 times return versus a 20 times on an outside bet. That's the whole thing about venture funding is about risk reward. Yeah. The risk actually that we would have is you move too far up the market to us that we wouldn't be able to fund. You wouldn't do an accelerator. You wouldn't do a typical seed round. That's the risk that we run.
Okay, we're running over time, but I've checked with Marco. Marco is saying that there is room for another question.
Let's just get one question. We're still 1 minute over.
There are more now.
One really short question.
Okay, very short.
Why are you doing that? When did you decide that acceleration is your business, and what's personally motivating you?
That was easy. I used to be a seed funder, and as I described to people, so this was about 3-4 years ago, but it was in a region, it wasn't London. And as I described to people, it felt like I was just buying really expensive lottery tickets, and the chances of it coming in were probably as high as getting a lottery ticket come in. So I basically said, instead of writing a check for 150 or 200,000, why don't we split it into 10 parts and write smaller checks, work with the teams for a period, and then from that we would establish which of the teams would be better validated for a bigger check. What I hadn't figured out, because I'm not very smart, is if you're a VC, you get to bigger pots of money, not smaller ones. So it's just you can't make money down here. In the scrapping around, playing with dimes or quarters, you will never make a lot of money.
I think I can speak for everyone on this panel when we say you have to love it. You know, you can't go to work every day and be like yet another startup. I mean, my background was as an engineer, and I loved looking at technology. I used to work in the research and development department, and I would look at startups for integration into the New York Stock Exchange trading floor. I would just love it. It's like I go home and I look at the latest Arduino stuff, and I love it. So the motivation is intrinsic. It's just you want to see that, and you want to see the coolest stuff grow and become the next big thing. That's it. It's really
okay,
simple.
there was one final question there. Quick.
Just a quick question about lean startup method. Don't you think it can be dangerous to expose something on the internet when you didn't have to do anything before on this product, and someone else can do it quicker than you because they have money or resources and so on?
No, I think the downside risk of exposing your idea is almost negligible to the upside benefit of getting validation and information. I think building a company in secret and stealth is what fools do. It's just a really bad idea. I also think there's almost no value in ideas. The value is in the execution. So if someone's going to build the company better, they're going to build the company better, and there's probably nothing you can do about that. Keeping it quiet for longer just delays the inevitable.
Coming back to what Sitar said earlier, doing a startup's a really stupid idea. The chances of it ever working are pretty slim to none. Okay, I'll say it's stupid, yeah. But on the balance of probability, you turning into a Facebook is like practically zero. The reason why people do startups is because they are passionate about what they do. Having seen an idea on the internet doesn't suddenly make you really passionate about it, because that's what's going to get you past all of the the no's and I think that's a stupid idea. You've got to battle through a whole pile of crap to get through to a really good startup, and it's not just looking at something and going, oh, I'll do that.
Okay, so we have run a little bit longer. If you like the panel and you appreciate it, you're going to clap. If not, you're going to boo. All right. Thank you.